Hi guys, today we are going to see Income Tax Inspector Exam 2023 Part 2. Before going into the video, kindly like, comment, share and subscribe for future videos. Question number 16. The provision of section 11 and 12 shall not apply in relation of income of the trust unless, so here the answer would be A. An application is made for registration of the trust before the expiry of 1 year from the date of creation of trust. Question number 17. Section 222E would not be applicable in which of the following cases? Let's evaluate which of these cases are correctly stated as situations where Section 222E would not be applicable. Correct. Section 222E is not applicable to public limited companies. Section 222E is not applicable when no shareholders holds more than 10% of shares. And it is not applicable when there are no accumulated profits. Same way, it is not applicable to firms and only to companies. Therefore, Section 222E would not be applicable in all of the given cases. So, the answer would be D 1, 2, 3 and 4. Question number 18. Inspector of Income Tax has been defined under Income Tax Act. So, let's see what are the subsections. Section 225 defines Income Tax Officer. Section 228 defines Income Tax Inspector. Section 219 defines Cooperative Society. Section 230 defines non-residents. So here they are asking about Inspector of Income Tax. So the answer would be B, defined under subsection 28 of Section 2 of the Income Tax Act. Question number 19. The trust can invest the accumulated fund in any of the following assert for availing the benefit of exemption under Section 11 of Income Tax Act 1961. To answer this question correctly, we need to consider the provisions of Section 11 of the Income Tax Act 1961, which deals with the income from property held for charitable or religious purposes. Let's analyze each option. Share of public limited companies. This is not specifically mentioned in Section 11 as an approved mode of investment for accumulated funds. B. Investments in protection of involvement. This option is unclear and not mentioned in Section 11. C. Government securities, deposits and bonds as specified under Section 11.5. This is the correct answer. Section 11.5 of the Income Tax Act specifies the forms and modes of investing or depositing money for trust to avail exemption. D. Government security deposits and bonds as specified under Section 11.4. This is incorrect. Section 11.4 does not specify investment modes, it deals with the business income of trust. So here the answer would be C. Government securities, deposits and bonds as specified under Section 11.5. Question number 20. Voluntary contribution received by an electoral trust shall not be included in its total income of the previous year only if, to answer this question correctly, we need to consider the provisions related to electoral trust under the Income Tax Act. Let's analyze each options. It distributes 90% of aggregate donation received by it during the previous year along with surplus, if any, brought forward from the earlier previous year. This is a correct condition for electoral trust. B. Such electoral trust function in accordance with the rules made by the central government. This is also a correct condition for electoral trust. C. Such distribution must be to any political party which is registered under Section 29A of People's Act. This is also a correct condition for electoral trust. D. If it complies with all the above conditions A, B and C. This option suggests that all the above conditions must be met. So here the answer would be D, if it complies with all the above conditions A, B and C. Question number 21. X, after about 30 years stay in India, returns to America on January 29, 2020. He returns to India in June 2022 to join an American company as its overseas branch manager. Determine his residential status for the assessment year 2023-24. So, for residential status, we need to consider two main conditions. A. 182 days or more in India during the relevant financial year, or B. 60 days or more in the relevant financial year and 365 days or more in the 4 years preceding the relevant financial year. In this case, X was in India for more than 182 days in financial year 22-23. From June 22 to March 23 is approximately 9 months, which is more than 182 days. Therefore, X satisfies the first condition of staying in India for 182 days or more in the relevant financial year. We don't need to check the second condition as the first one is already satisfied. However, we need to determine if X is resident and ordinary resident or resident but not ordinary resident. For resident or ordinary resident status, X needs to satisfy two additional conditions. A. Resident in India for at least 2 out of 10 previous years preceding the relevant year, and B. Present in India for 730 days or more during 7 years preceding the relevant year. Given that X was in India for about 30 years before leaving in Jan 2020, he would satisfy both these conditions. So the answer would be C, both resident and ordinary resident in India. Question number 22. To avail the exemption under section 11 and 12, an assessee applies for registration. The registering authority has how much time available for disposing of the applications. So here, the principal commissioner or CIT must dispose of the application within 6 months from the end of the month in which the application is received. So the answer would be A, 6 months from end of the month when application is made. Question number 23. Which of the following is not included in the personal effects as per the provision of section 214(2) of the Income Tax Act 1961 dealing with provisions relating to capital assets? As per this provision, personal effects are defined as movable property including wearing apparel and furniture held for personal use by the assessee or any member of his family dependent on him. However, it explicitly includes the following items from being considered as personal effects. 1. Jewelry, archaeological collections, drawings, paintings, sculptures, any artwork. So the answer would be A. Jewelry. Question number 24. Which one is correctly matched about tax treatment of gratuity? So before going into the question, let's see what gratuity is. Gratuity is a sum of money paid to an employee by the employer at the end of a period of employment. For non-government employees covered by the Payment of Gratuity Act 1972, the exemption is provided under section 10(10)(2), not 10(10)(4). Moreover, it is not always fully exempt. Next, non-government employees not covered by the Payment of Gratuity Act 1972, it is fully or partly exempt from tax under section 10(10)(3). So here the answer would be D. 1 and 3 are correct. Question number 25. Basic salary and dearness pay are charged to tax under section 15. The tax treatment of other receipts is given below. Statement 1. Advance salary is taxable on receipt basis in the assessment year relevant to the previous year in which it is received, irrespective of the incident of tax in the hands of the employee. This is correct. Statement 2. Arrear salary is taxable on receipt basis if the same has not been subject to tax earlier on due basis. This is also true. So both the statements are true. So the answer would be D. Both are correct. Question number 26. Section 35 of the IT Act 1961, subject to fulfillment of certain conditions, provides for the following deduction in respect of expenditure on scientific research. So let's see what section 35 is. Section 35(1)(1). Any expenditure not being in the nature of capital expenditure laid out or expended on scientific research related to the business is allowed as a deduction. Section 35(1)(2). An amount equal to 1.5 times, that is 150% of any sum paid to a research association that has its object the undertaking of scientific research or to university, college or other institution to be used for scientific research is allowed as a deduction. Section 35(1)(2)(a). Any sum paid to an Indian company having its main object of scientific research and development and to be used by it for scientific research is allowed as a deduction. However, The weighted deduction of 150% has been phased out and only 100% deduction is allowed for payments made after March 31, 2020. So the answer would be B, 1, 2 and 3 only. Question number 27. For taxability of income from house property, the ownership of the property is one of the precondition. In this regard, which one is the correct statement? For the taxability of income from house property, the ownership of the property indeed a precondition. Here is the correct information regarding the statement. 1. Owner means a legal owner for the purpose of section 22. The owner may be an individual, firm, company, cooperative society or association of person. The term owner refers to the person who is entitled to receive income from the house property in their own right. So the first one is correct. 2. Deemed owner of house property can be charged tax on the annual value under the head income from house property. Deemed ownership arises in cases such as transfer to a spouse or minor child, holder of an impartible estate, member of cooperative society and other specified cases under section 27. 3. Income from subletting is not taxable as income under the head income from house property. Instead, it is taxable as income from other sources because the person subletting the property is not the owner but a tenant. So, the answer would be C, 1, 3 are correct. Question number 28. As per section 24B of the Income Tax Act, where the property has been acquired or constructed with borrowed capital, the interest, if any, payable on such capital borrowed for the period prior to the previous year in which the property has been acquired or constructed, as reduced by any part thereof allowed as deduction under any other provision of this act, shall be deducted under this clause in dash number of installments. So here the interest paid during the pre-construction period, that is before the house property is acquired or constructed, can be claimed in 5 equal installments starting from the year in which the acquisition or construction is completed. So the answer would be D5. Question number 29. As per section 35 DD1, amortization of expenditure in case of amalgamation or demerger is allowed as deduction for dash beginning with the previous year in which the amalgamation or demerger takes place. So what is amortization of expenditure? Amortization of expenditure refers to the process of gradually writing off the cost of an intangible asset over its useful life. What is amalgamation? Amalgamation means combining multiple companies into one, ceasing the existence of the amalgamating companies. What is called as a demerger? Splits a single company into multiple entities with the original company and the new entities continuing to exist independently. So here the answer would be 1/5 of such expenditure for each of the 5 successive previous years. Question number 30. Bad debts allowed earlier and recovered later on tax under section. So let's see all these sections. Section 41(4) of the IT Act specifically deals with the recovery of bad debts that were previously allowed as deductions. Section 31(4) does not exist in the Income Tax Act. Same way, Section 21(4) also does not exist in the Income Tax Act. So here the answer would be Section 41(4). Thank you for watching the video, guys. Stay tuned for the next video.